Thank you for joining today's session on flood insurance changes. This session is part of the third Thursday regulatory briefing series from Virtual Compliance Management. A couple of housekeeping items before we begin. During the session, all participant lines will be muted. We do welcome your questions, though, in the chat window of your Join.me app. We will aggregate those questions and ask James to address them at the end of the briefing. In addition, we will email a copy of the slides used today, as well as a link to the recorded session so that you can play it back later for reference or can share with interested colleagues. With that, I would like to welcome James DeFrance, today's facilitator. James is a consumer and real estate lending compliance specialist with more than 30 years of experience in banking. He has served as a senior compliance examiner at the Federal Reserve Bank in San Francisco and has served as a commissioned national bank examiner at the OCC. James holds a BA from Dartmouth College and a JD from the University of San Francisco with a concentration in banking and finance. He is a certified regulatory compliance management and anti-money laundering specialist with experience in fair lending, consumer operations, non-deposit investment products, note department operations, BSAs, CRAs, and the entire credit approval process. James, welcome, and thank you for facilitating today's session.
Well, thank you very much, Catherine. And I just want to take a moment to remind you that we conduct these webinars every third Thursday of the month. And we invite you to join us. They are free. Invite members of your staff and enjoy. We very much appreciate your attendance at this one. Good morning and good afternoon to each and every one of you. Today we're going to talk about the new flood rules, and these rules come into effect at the beginning of the year. First, let's talk a little bit about flood insurance and what it's really supposed to do. In 1968, Congress created the National Flood Insurance Program, also known as the NFIP. Since most homeowners insurance didn't cover flood, property owners who experienced a flood often found themselves financially devastated and unable to rebuild. The NFIP was formed to fill the gap that was designed to incorporate community adoption of minimum standards for new construction and development to minimize future risks of flood damage. Pre-existing homes and businesses, however, could remain as they were. Owners of many of these older properties were eligible to obtain insurance at lower, subsidized rates that did not reflect the property's true flood risk. That's reading directly from the flood insurance regulations, and that is the basic reason why we have flood insurance. So really, when we talk about flood insurance, what are we talking about? We're saying when real estate is used as collateral for a loan, there has to be a flood determination. If the flood determination says that the real estate is in a flood zone, then the customer has to be notified, and flood insurance has to be purchased before the loan is funded. The amount of flood insurance, of course, is the lesser of the loan amount, the value of the improvements, or the maximum amount available. For those of you who are in compliance, this is all very familiar to you, I'm sure. What's the problem? Pretty easy, right? You do the notice, you determine that it's in a flood zone, you get the insurance in the proper amount, and there's never a problem, right? Wrong. Flood insurance tends to be one of the areas that is most often cited by the regulators. For whatever reason, there seems to be always violations. Questions like this: when is a structure, tends to vex people, has vexed people, and hopefully won't continue to vex people as much as we get into what the changes in the rules are. But when exactly is a customer supposed to be notified? You know, the regulations say it's within a reasonable time. For those of you who are wondering, the regulators, from what we've heard, said that the reasonable time is 10 to 15 days before the loan is funded. There's no actual written regulation that says that, but that is the standard that you will be held to. How do you calculate the value of improvements? Generally, you use an appraisal. That's not always the case.